Hey guys, it's Adam. Today I want to try a bit of a different setup. As you can see, I didn't just want the plain wall behind me anymore. I thought it was a bit boring and it also wasn't great for the lighting. So I hope that this is a little bit nicer. Let me know what you think. So first of all, as you probably know, when you're adding an investment to your portfolio, you really want to know how the business is performing. Because obviously you don't want to invest in a business that isn't going to perform well and it isn't performing well at all. Now, one of the best and easiest ways to do this is by looking at the dividend yield. In my experience and my personal opinion at least, it really does give you an insight into the business. So first of all, I need to say that dividend investing isn't a bad way to invest because it really is good for a lot of scenarios. Yeah. So when you're in a bearish market and there's been some sort of collapse or downfall, like earlier this year, you really don't want to be having shares that don't offer dividends. Dividend shares will continue to provide you with an income even when the market's not doing great. Now, it's always possible for the company to reduce the dividends they send out or to get rid of them completely. However, I'd still say it's a better bet to have dividend stocks in a bearish market. Dividend yielding companies can act as a sort of buffer when there's a steep portfolio drawdown. So anyway, now that you know kind of why you should have dividend investments, I'm going to now explain, which is why you came here I assume, what is a dividend yield. So pretty much, a dividend yield is just the amount of interest that a company offers in terms of what is called a dividend, which is just a payment that comes in a period. This can be a different period for every company, however a common one is quarterly, annually, or per half the year. Now let's say, for example, a company gives you $1 for every share you own quarterly. So that means $4 annually, and let's say the unit price is $100 a share. This means that the dividend yield for this particular share would be 4%, which is something which is quite good, especially in the US stock market. That is quite a good yield you can get. In some other countries like Australia, you can end up getting like 6% yields, and 3 and 4 is quite common. So that's just a short example and definition of a dividend yield. So hopefully you kind of have a bit of an understanding there. But stick with me because I still want to talk a little bit about dividends. So the reason dividend investments are quite attractive is because it allows you to invest and get passive income without selling your shares. Usually, if there wasn't a dividend, you would only create a profit if your share goes up and you sell it while it's higher than what you bought it for. So like I said before, you end up getting paid like quarterly or annually, and you will always get that payment as long as you have the share. Now this means that especially once you've retired, you want that passive income because you're most likely not going to be working. When you're retired, you shouldn't be working, that's what retired is, so you want to still be having an income. Now whatever you do with this dividend is completely up to you. Personally, I'd say unless you're getting close to your retiring years, I would be putting them back to reinvest. Now that's just personally my opinion, but the reason I do that is because when you automatically have your dividends reinvested, you skip any fees your brokerage has. And personally, the brokerage I use has a $20 fee in and out. So whenever you buy, you need to pay $20. So I don't want to stick with that fee, so I automatically reinvest my dividends. Let's say you own 50 shares of a company that has the share price of $100. And let's say that that has a 2% dividend yield. That means that every year you will get one more share of that company. Alternatively, you really can just take the dividend in cash. It's up to you, but that's just my personal preference. I like to reinvest them. But I'm still young, and I don't know if you're young or if you're older, but it's really depending on who you are. Maybe you need that passive income to increase how much you can spend each week. I personally don't. I'm still young. I don't really need that much money yet. Now, although a dividend yield can tell you a lot, it's not the best indication. However, it still does give you a vague understanding. But something I wanted to say quickly to watch out for is if there is a dividend that is too high, like a dividend yield of like 15% or something that's just a little bit too high, don't get too swayed into buying it because there's always a downside to things like that. I mean, maybe there isn't, but in some scenarios, they can actually take out debt to pay those dividends, and long term, you don't want to be with a company that's taking on that much debt. Now, the reason that companies pay dividends, typically blue chip stocks, is because they don't have much room to scale anymore. So for example, let's say Home Depot, they've got a store almost everywhere in the United States. There's not that much they can do to scale their business. So it's more worthwhile for them to spend their money giving you guys your dividend payments in order to attract more shareholders. Whereas, alternatively, if there was a company that's a penny stock startup and they really didn't have much funding at all, they could much better use your money to grow their business and scale because there's so much room for them to grow. Which is why usually with penny stocks, which are quite risky, there can be such a big reward when they grow because they've got so much room to grow. Blue chip companies don't have that much room to grow. Some of them are global or they're just nationwide and they are huge. They really don't have that much they can do to scale too much, so it's more worthwhile for them to simply just pay a dividend. So hopefully now you understand what a dividend yield is and why you should or shouldn't invest in dividends. Like I said, it's completely up to you whether you invest in dividends or not, but do keep in mind that it can be a good indication and it is great long term, and also the auto reinvesting is actually quite helpful. Just real quick guys, I'd appreciate if you could hit that like button down below. It really helps me out for the YouTube algorithm and I'd like to share these videos with more people than I currently am. I do this completely for free. I don't really earn a lot from it except for a bit of the reward from seeing my subscriber count go up. If you could subscribe, I'd really appreciate it. I just want to give out my education to other people because something I strongly believed in was that the education system doesn't teach us enough about money. And me being young and interested in money, I thought we need to have a way to educate other people on finance. Personally, I learned a lot from YouTubers like Graham Stephan, and really, from all of that, I just really think it's great, the way that we can just hop on YouTube and learn so much. That's the reason I personally started my channel, so I'd really appreciate if you could help share me around, help watch my videos, subscribe, whatever you can do. They're all free ways you can help me out, and I'd really appreciate it. Let me know in the comments down below, do you invest in dividends? Do you think they're good? Do you think they're bad? And why do you invest in them? Also, let me know if I missed anything important. Share your knowledge around with the people in the comments section because I really just do want the best for all you guys. Thanks so much for watching the video guys. Click here if you want to watch this video which YouTube chose specifically for you. Hopefully you enjoy it if you watch it and have a great day. Thanks guys.